Recession fears, they've been ripping through the markets in recent days, although maybe a little calmer here today. How would you characterize the demand environment right now?
Yeah, well, I'd say it's mixed, but generally positive. You know, the chemical business is our largest franchise, has been up significantly year over year. International modal continues to be strong. A lot of the rate-sensitive areas, housing, lately autos, some of the metals and steels have been down a little bit lately, so we're watching that one very carefully. But we see a strong second half of the year for us, the things that we have visibility to. And we're still feeling pretty good about where things are. And we said we'll have meaningful margin expansion in the second half of the year. That largely comes from the back of holding costs flat and growing revenue.
I want to get into that a little bit more here in just a moment. But listening to you, it sounds like you think soft landing thesis is still intact.
I think so. I mean, we're all anxious to see what the Fed does in September, to be sure. Autos were up in the first half of the year, based on my experience in the auto industry. Watched that one very carefully. And then in July, we saw the shipments slow down a little bit. So watching that one very carefully. And as you've seen the steel companies come out with their earnings announcements, it's been not a great year so far for them. So those areas we're watching very carefully. But we expect a strong Midwest harvest in the fall, which could be good for us. Chemical business is strong. Export coal business is still very strong. Minerals, aggregates, construction is still strong. So again, mixed, but generally positive.
With the steel piece of this and the metals piece of this, that's particularly interesting to me because we know a lot of government money has pushed out into infrastructure, has pushed out into other things like IRA, et cetera. Have we seen the peak in that spending then in terms of these infrastructure projects? I mean, should investors think that spending's been deployed?
Well, we're still seeing it on the construction side. I think aggregates, think rocks, think minerals that go into that. So the steel is, I think, more consumer driven than the construction piece of it. So it's a little bit mixed because we're seeing the aggregate side still be very strong, mostly in the southeast, Florida, and also in the rest of the southeast. So there's still a lot of construction going on. Industrial development is still big and strong in the southeast. I think we've got to watch the consumer side of this.
Okay. You're expecting low to mid single-digit total volume and revenue growth in the second half of 2024. What's propelling it? And perhaps just as importantly, a couple weeks ago, Norfolk Southern CEO Alan Shaw came on. He said to me, looks like we're going to get a peak season this year, which we haven't had, as retailers and other consumer-facing companies begin to rebuild their inventory levels. You expecting the same thing?
Yeah, we hope so. I mean, with big customer bases like UPS and Amazon, and of course Schneider Logistics, they're telling us that things look pretty good for the second half of the year. Domestic intermodal the last couple months has been down a little bit for us year over year, while international has been strong. So we're hoping to see that come true in the second half of the year. We still think international intermodal will be strong coming into the port, so that should be good. Again, what's driving it is chemicals, export coal. Autos so far this year have been strong, aggregates, and we expect the Midwest harvest to be strong. So we see a lot in the future that's good for us. We've got to make sure that the economy keeps moving forward.
Okay. Labor talks at the East and Gulf Coast ports, those seem to be largely stalled. There's rising risk that we're going to see strikes by workers at those ports. How are you gaming that out? And what does that mean in terms of some of these container flows when you already have diversions away from the Red Sea and you've had issues in Panama Canal?
Yeah, for us, actually, we don't see a net negative effect if the eastern ports have a stoppage. We don't expect that. We hope that's not the case. Because if things move west, they actually still need to get to the east where the population is. So that means a lot more movements of rail all the way across the continent from Chicago with us over to the east, where a lot of it goes into the ports in the east, gets trucked to New York, Baltimore, Philly, et cetera. So actually it could be a net benefit to us. We don't hope that happens. We don't want it to happen. Obviously watching what happens in Canada as well. So from a CSX standpoint, we should be okay either way. And we're watching it very carefully, and we're gaming it out, and obviously our shippers are doing that as well. But for CSX, we should be in a good place.
Okay. We talked about the meaningful improvement in operating ratio in the second half, better efficiency, better profitability. How do you get there? How does pricing factor in?
Yeah, pricing's been strong on the merchandise side so far this year. We see that continuing. And obviously, we came off of a lot of inflation over the last couple of years, but we have a leading service product. I mean, our service leads the industry, and customers are willing to pay for service. To a certain extent, we're seeing that play out. For us, the second half of the year really is about growing volume and revenue while holding our costs in line. The last couple quarters, our costs have come down. We're seeing good efficiency from our whole One CSX team working well together. So our headcount should stay pretty flat second half of the year, revenue up, volume up, and that's where the margin expansion should come from.